Hello and welcome to Chapter 5, the chapter on National Income Accounting. So we have covered 4 chapters already and we are in Chapter 5. So in this chapter we will discuss how much output is being produced by the nation and who uses this output and how much income is being generated and what is happening to prices and wages. So let's begin this chapter. So here we have so we measure, just like the progress in a class, just like your grade report, we measure the country's progress by looking at our GDP. How much is our gross domestic product? So gross domestic product is simply the total market value of all goods and services produced within our nation's borders in a given time period. It doesn't matter who owns the resources. It could be Japan, it could be China, anybody else can invest, but it is geographically based. So all of these goods and services produced within a given time period, that's how we calculate how much output have we produced. So that's our GDP, and currently our GDP is about 14 point some trillion dollars. Okay, so then we have to look at GDP in terms of physical output and in terms of dollar output. So simple example, let us say we produced 100 items of something last year, and this year we produced 200 items. So we have produced more goods and services, right? So instead of 100, now we produce twice as much. Okay, now let me go back to the previous example again. Let us say we produced 100 items, and today our price level, last year our price level was $1, so we produced $100 worth of goods and services. Now in year 2, what happened is prices doubled. So everything that was $1 is now $2. So we say we have produced $200 worth of goods and services, but in terms of physical output, we still produced 100 items, and we are still producing 100 items the next year, but only the price level has gone up. So we need to measure the real GDP in terms of actual physical goods and services. How much more did we produce minus the price changes? So in this example, in this slide, when you look at oranges, we produce 2 billion. This in the following year we have produced 3 billion, gone up by a billion. Bicycles have gone up by 2 million. Rock concerts went down by 100 million. So in monetary terms, we simply multiply times the prices. 400 million is our oranges, 100 million is our bikes, and 700. So total output was 1200 million here. And in monetary terms, in the next year, our prices are still 20 cents, same holds, but the 3 billion oranges, now more output, 600 million. Again, same price. We have 600 rock concerts at a million. So we have produced 1400 million dollars worth of goods. So we can measure the output basically in terms of nominal GDP, which is the dollar value, or in real value by removing the price changes. Okay, so GDP is basically geographically focused, versus GNP, our gross national product, is depends on the factors of production we own in other countries. So whatever the income our factories have earned from abroad, and we bring all that money back into this country. So that is how we calculate the GNP. The gross national product is output produced by our nation, factors of production, no matter where it happens. GDP is geographically based. GNP is factor owned, who owns the factors of resources. The next measure that we have is the GDP per capita. So here what we do is we take the country's GDP and we divide it by the population to figure out on the average how many goods and services are available to each person. So it helps us measure kind of an approximate measure of the standard of living. So in our country it is about 45 to $50,000 worth of goods and services we are producing. Take the 14 trillion and divide it by a population of 320 or 330 million. And that is the average output each person. If we distributed all the GDP, each person would receive that much. It does not mean actually that they would receive that. So it's just a rough measure of what how many goods and services are available per person in a country. So it doesn't say anything about the statistical average. So we have some problems with the GDP. So the GDP measures basically all market transactions. So it does not include any non-market activities. If you exchange babysitting services for me, or we barter and exchange, and then those goods are not included in there. So those are non-market activities. And a lot of those market activities, so we have underreported GDP in that case, whether it is child care, home repair, car repairs, catering, and so on, lawn maintenance, and so on and so forth. And the second problem we have with the GDP is it does not measure unreported income. Of course, illegal activities take place. You go to downtown LA and you buy, say, if you pay cash, it'll give you a different price, and if you use the credit card, it's a different price, because whatever you pay cash, it goes under the table and they don't report it as sales. So that's unreported income basically. And so that's why they give you the discount, because they don't have to pay taxes on it. So an unreported income, whether it's under the drug deals, that illegal activities that happen. So the government loses quite a bit of money. It lost, in fact, 195 billion in year 2000 with the unreported income, and those are the amount that you're not collecting taxes on. So the discussion that we have in our unit is about legalizing the marijuana. So if we legalize it, what happens is the unreported income would obviously that would go down, right? I mean, you'll have more people reporting income, so we can collect taxes on it. But of course, there are other things that we'd have to consider. What are the repercussions of that? Of legalizing it, and there'd be undesirable other consequences. So the second method, there are a couple of ways we can calculate our GDP. One is the expenditure method. Let us say you earn $1,000 or you spend $1,000. So we can say you spend $1,000 on goods and services. So we can calculate how much you earn by looking at, because income and expenditure will equal. So either you can say how much did you make versus how much did you spend. So either way, we get the same answer. So the value added approach is another approach where intermediate goods and services, you keep at every stage, you look at what was produced, how much value was added, and finally we look at the final goods and services at each stage. So the intermediate goods are simply goods that are used to produce in the production of final goods, and so it takes place at each production process. So if you look at this slide, farmer grows wheat, he sells it to the miller at 12 cents, and obviously the miller is now going to convert that into flour. So he added value of 16 cents to it. So now he'll sell it at 28 cents. And the next person, baker, adds 32 cents worth more by baking it and selling it to a store. And the bagel store sells it to the consumer for 75 cents. So the total is $1.75 in the value added approach. You don't add all the so basically each person at each stage represents an addition to the value, to the output basically. So they were proposing about the value added tax, and maybe that's how we should collect tax. That was one of the proposals. So there are other ways to calculate GDP. So you compute the final output, count only market transactions, look at the final sales, or count only the value added at each stage. So you'll come up with the same thing basically. So like I said in my example earlier, real versus nominal GDP. Nominal is simply the dollar value in the current prices. Real GDP is you adjust for the price changes. You take out the inflation, whatever the price changes happen, and you figure out, did we really increase the actual output. So inflation is an increase in the average level of prices, and it distorts the GDP if you don't take out, just because $100 of output and prices doubled, you say, wow, we grew and we produced $200, but that's not true because prices just doubled. So we need to pick up a base year, and from the base year we can compare how did we do relative to the base year. So we have real GDP in year 10, nominal GDP divided by the price index. So the base year is always a price of 100, and so whatever the new price index is, whatever, if something cost $100 last year and this year it costs $105, so there's a 5% change in prices, so 1.05, right? So that's how you would calculate the GDP. So in this example, in year 2005, we produced $12.4 trillion worth of GDP. Okay, and our real GDP, because that's our base year, so it's the same amount. Next year we produced 13,245. So we can say, wow, we produced 13.2 trillion. We really grew. But we have to take out the price level. We know our prices went by 3.30%. So whatever cost you a dollar, now it costs you dollar or 3.3. So whatever cost you $100, in other words, it costs you $103 now. You have to pay $103.30 for the same item that cost a dollar a year before. So what you're going to do is you're going to take care of the price index on the denominator, take the $103 divided by 100, and then you take your GDP nominal and divide by that to find out what's the real change in the GDP. So the real change in the GDP, it comes out to you grew only by not 13,245 but 12,822. So know how to calculate. Look at the price index. It's simply telling you whatever was the base year's 100. If it's 5%, so it costs you $105. If the change in the price roll was 10%, what cost you in the base year 100 is now $110. So we take the change for the current year and divide it by the base year to come up with that number, and then divide by with a numerator to come up with the real increase in the GDP. Okay. So if you look at our increase, our real GDP was growing from 1995 up to the base year. Base year is obviously relative to the base year. So this is our base year. So, but our real GDP has been falling when we look at the trend here. So this is our base year. The base year where real and nominal will always equal. So relative to the base year, the GDP was higher, obviously, because we picked that as our base year. So again, like going back to, so let me pause here and then I will do the second part of the recording here, and then we'll talk about the net domestic product.